The story begins in the early 2000s, characterized by low interest rates and a push for increased homeownership. Investors, seeking higher returns than government bonds could offer, began pouring money into the U.S. housing market, creating a massive influx of capital. To satisfy the hunger for mortgage-backed securities, lenders lowered their standards. Subprime mortgages, loans given to borrowers with poor credit histories, became common, often featuring teaser rates that would skyrocket after a few years. Wall Street investment banks bundled these risky individual mortgages into complex financial products called mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, selling them to investors worldwide as safe, high-yield assets. Credit rating agencies, paid by the very banks issuing these products, gave top-tier AAA ratings to many of these mortgage-backed bundles, misleading investors into believing that the underlying subprime loans were virtually risk-free. By 2006, U.S. home prices peaked and began to decline. As interest rates rose, many subprime borrowers found their monthly payments doubling or tripling. Defaults began to climb, and the value of the safe securities tied to those loans started to plummet. In early 2008, the prestigious investment bank Bear Stearns faced a massive liquidity crisis as its mortgage-backed assets lost value. To prevent a total collapse, the Federal Reserve brokered a fire sale of the company to J.P. Morgan Chase. By summer 2008, the two government-sponsored enterprises that guaranteed half of the U.S. mortgage market, Fannie Mae and Freddie Mac, were on the brink of insolvency. The U.S. Treasury was forced to step in and take them into conservatorship. September 15, 2008, marked the most dramatic turning point. The government declined to bail out the investment giant Lehman Brothers, leading to the largest bankruptcy in U.S. history and sending a shockwave of terror through global markets. Just days after Lehman's fall, the insurance giant AIG faced collapse due to its involvement in credit default swaps. Deemed too big to fail, the government provided an $85 billion emergency loan to prevent a total systemic meltdown. Trust evaporated instantly, banks stopped lending to one another, and the plumbing of the global financial system froze. Businesses couldn't get short-term loans for payroll, and the world stood on the edge of a second Great Depression. The U.S. Treasury proposed the Troubled Asset Relief Program, TARP, a $700 billion plan to purchase toxic assets and inject capital directly into struggling banks. After initial rejection and a stock market crash, Congress passed the bill in October 2008. The crisis wasn't limited to America. European banks holding U.S. mortgage securities began to fail, and countries like Iceland saw their entire banking systems collapse. Global trade slowed to a crawl as the recession took hold worldwide. The financial crisis bled into the real economy. In the U.S. alone, nearly 9 million people lost their jobs, and millions of families lost their homes to foreclosure. Trillions of dollars in household wealth and retirement savings vanished. In 2010, the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed. It aimed to end too big to fail, restrict the types of speculative bets banks could make, and create a new agency to protect consumers from predatory lending. The 2008 crisis reshaped the world. It led to a decade of slow growth, record low interest rates, and a deep-seated public distrust of financial institutions and political elites that continues to influence global politics today.